Hey guys, what's going on? My name is Hamishwhodder and we are back with another episode of the YouTube Stock Portfolio, the series where we go through and analyze businesses and add them to our public portfolio as we build it over the next few months and years. And today is that time of the month where we go through and have a look at how the public portfolio has been performing since we bought the stocks and also in the past month, and just sort of talk about some of the news relating to the stocks that we hold in the portfolio. And I also want to talk about some of the stocks that we might be considering adding into the portfolio in the near future. As you would know, stocks have been falling over the past month and it's offered some buying opportunities in some of the businesses that we're looking to invest in. So we're going to talk about some of those and what prices we'll be looking to invest and build our portfolio over the next few months. If you do enjoy the video today, make sure you leave a like below. It doesn't take you too long and it helps me out a ton. But for now, let's jump into it. So let's start off by talking about the SPY index proportion of our portfolio. So if you haven't been following along, first, I recommend that you go back and watch all of the episodes, but if you haven't been following along, a significant proportion of our portfolio, about 50%, is just invested in the index fund SPY, which tracks the S&P 500, which is the top 500 companies in the United States. And just quickly, the reason that we have such a significant proportion of our portfolio in an index fund is because we're taking this series from the perspective of an absolute beginner, and I think that it's really important if you're a beginner, even if you're not a super beginner, but you are pretty new in the stock market, I think it's really important to have a significant amount of money just tracking the broader market, because the US economy and the Australian economy for that matter will continue to go up over the long term. So it's good to have that foundation in your portfolio. But let's now have a look at how the SPY index has been performing over the past month since our last update, as well as since we purchased it. So in the last month, in the month of October, the SPY index is actually down 9.55%, which is really significant. And if we have a look at the performance of the portfolio since we first purchased it, since we first made our first investment, it's down 6.8%. And for me, as a long-term investor, that is a really good sign, because for me, and I know it's the same for many of you out there, your investing horizons are going to be 40 or more years. You're going to be in your 20s or your 30s, maybe even in your 40s, where you still have 20, 30, 40 years of investing to go. Then seeing stocks fall in the short term just gives us a better opportunity in order to load up on these stocks and on these index funds and sort of build out our portfolios, because it doesn't really matter if stocks go up in the next couple of years, if they're just going to go down again and then go up again. What we really want is we want stocks to go down right now so that we can load up on them, and we want them to be higher obviously when we're going to be selling them, but that is very far down the road, probably 30 or 40 years. Personally, I don't think it's a smart idea to try and predict when the stock market is going to bottom out in this correction, how far it's going to go, is it going to continue, all of that sort of things. But there are a couple of factors that are putting downward pressure on stocks, and that they're going to continue to put downward pressure on stocks over the next couple years. The first factor is the tariffs that Trump has put on many countries and has put significantly on China, and these tariffs are starting to have negative impacts on company margins. Many companies who have been reporting this season and also 3 months ago have mentioned that the tariffs are starting to increase their costs, which is squeezing their margins, and many are guiding that this is going to continue into 2019. The second factor is that interest rates are continuing to rise and will continue to rise in 2019. I think there is one more interest rate rise set for this year. I think it's in December, and then there's 2 or 3 more rises set to happen or expected to happen next year. Now, if you don't understand how interest rates work, essentially they affect businesses in 2 ways. The first is that they reduce consumer spending, which directly hurts companies' revenues and profits. But it also causes the risk-free rate to rise, which is widely used in valuing companies. In short, higher interest rates make risk-free bonds more attractive relative to stocks, which hurts the intrinsic valuation of businesses. So let's now talk about that second position in our portfolio, which takes up about 25% of our portfolio, and that is Facebook stock. Facebook over the month of October has made a return of negative 12.5%, so a little bit worse than the broader market. and since we purchased it, it's dropped over 21%. Again, this may seem scary, but it's definitely not a bad sign if you're a long-term investor. Now, I'm recording this on Tuesday and Facebook's earnings come out tomorrow, so I haven't been able to look and talk about Facebook's earnings in this video. However, it will be interesting to see how that affects their performance over the next week. Generally, in the last couple of weeks, tech stocks have been getting hurt, even though they've been coming out with really good numbers, and Facebook stock has been hurt from other tech stocks being hurt as well. So hopefully that lowers the bar a little bit for Facebook, but it'll be interesting to see what happens, and I'm excited to talk about it with you, some of you guys, down in the comment section below. So let me know your thoughts on Facebook's earnings, and I will be happy to have a discussion about it down there. And lastly, we've got our third stock in our portfolio, which of course is THO Industries, and again, this stock has been hurt significantly more than the broader market over the past month and since we've purchased it. Over the past month, THO Industries has dropped a whopping 22%, which is insane. It's an insane drop, and since we've purchased it, it's dropped 32%, which again is a massive drop in a stock. THO has continued to fall quite dramatically despite the company performing exceptionally, and nothing has happened within the actual company. Company's still growing at double digits. Nothing surprising there, which tells me something. It tells me that the market is already pricing in a recession. Everyone is expecting a recession to hurt THO Industries' earnings. And this is good for a couple of reasons. The first is that if we do go into a recession, a significant proportion of the downside for THO has already been priced into the market. Now remember, markets operate on expectations, not events. So the expectation of a recession is why the stock is falling now, and it's why cyclical stocks like THO Industries generally fall really hard before a recession even happens, and then they recover really quickly before the rest of the stocks in the market recover. The second point is that we may not even have a recession in the next couple of years. Granted, it's highly likely, and it's pretty much consensus now that we're going to have a recession in the next couple of years. But what can happen is we can have a time where the stock market can correct 20, 30, or 40%, but the rest of the economy doesn't go into a recession. It's just an isolated stock market crash, which then recovers. And this has happened in the past. So it's not necessarily certain that we will have a recession. It's possible, of course, and it's even likely that it will happen. But if it doesn't happen and the market has already priced in a recession, we might see THO Industries recover quite rapidly over the next couple years. We will just have to see. Now, I've had a lot of people message me about THO Industries and say that they're not interested in THO Industries because it's not likely to go up over the next 1 to 2 years. And I just want to spend a little bit of time talking about why that's a really bad strategy to have and why it's a much better strategy to look at stocks that have short-term bad horizons where they're probably going to get hurt in the next couple of years, but they have long-term profitability and their performance over the long term is likely to be really successful, like a business like THO Industries. Now, what you're looking at on screen is just a little graphic that I just whipped up to explain what I'm talking about here. So on the left, you can see we're in 2018, and that in market there represents the price that we bought in THO Industries. So we bought in at about $95 per share. The X represents where the stock price is currently. It's currently at about $65 per share, so that's that 30% drop that we just talked about. And then we have the out marker, which is the conservative price that I see the company being at in 2028. So a lot of people see this and get worried because it's not what they expected to happen. What a lot of new investors expect to happen, and what a lot of new investors want to happen, is that they want to get in at the stock and then they want to see it rise quickly to the sell price where they can sell it quickly before the 10 years is over. Now, while that might seem like that's what you want to happen to the stocks that you're going to own, it's actually not what you want to happen, and it's not what the greatest investors want to happen. There's a saying in the stock market, and I think Warren Buffett coined this term, where he says that if stocks go up, we make money, but if stocks go down, we get rich. And I'll show you exactly what I mean. So what we really want to happen is that we buy in at 95, and then for the majority of the next 10 years, we want the stock to remain undervalued. because that gives us more opportunities to add to this position and build it up to the biggest position we can possibly get before it rises back to its value where we can sell it at around $300 per share. And there's really two main reasons why you want the latter to happen. The first is that if the stock stays undervalued for 5 or more years rather than going up straight away and returning to its value, you have more time to build up your cash position from income and savings and that sort of thing, and from other stocks, for you to invest into the business, and you can build up that position over a long period of time. And the second reason is that it's just not realistic for you to pick the bottom of a stock and to see it start to rise up as instantly as soon as you've made an investment. And in fact, it's really dangerous to chuck all of your money into a stock at one time, because it's really hard to pick where the stock is going to go in the short term. What's a better approach is to invest a little bit and see what happens. Hopefully the stock goes down and you can invest more, bring down your average price, and hopefully it stays down for many years so that you can continue to build up that position and get the lowest price possible before it returns to its value. One mistake that I see so many beginners make is that they try and time the market. They try and pick the point at which the stock is just going to rocket off and go up to their fair value straight away. And for this reason, they invest a significant amount, or the entire position or the entire investment that they're willing to make, they invest it all at once, and then the stock falls 50-60% and they have no more money to invest into that business. So that was just something I wanted to share with you guys. And to summarize, I hope that THO Industries continues to go down. I hope we have a recession. I hope that the stock gets beaten to a pulp so that I can continue to build that position and build it out as big as possible before it returns to its value, which is its long-term double-digit profitability. So for the final bit of this video, let's talk about some of the additions we can add to the portfolio over the next few months. Now, I won't talk about THO Industries and Facebook, although if their prices continue to fall, of course, we will be looking to add to those positions. But I want to talk about one more stock that I'm looking to invest in, and we spoke about it last week. It's Google. Now, in last week's episode where we spoke about Google, I mentioned that a good entry point or a good starting point for building a Google position would be about $910 per share. That would mean that Google would need to fall another 12% in order to reach that price, which really isn't unrealistic considering they've dropped 15% just in the past month. Now I want to hear what you think about the markets and where they're heading in the next few months. While I don't think that it's accurate or that it's possible really to predict where the market's going to go in the next few months, it certainly is fun to discuss different factors that are impacting the markets and where it could head in the short term. So let me know your thoughts down in the comment section below. And of course, by the time this video is out, Facebook's earnings for the third quarter of 2018 would have come out. So I'd love to hear your thoughts on that, and I'm excited to have a discussion with you guys about that as well down in the comment section below. If you enjoyed the video and you do want to see more, make sure you hit that subscribe button and join the team. We come out with 3 new videos every single week, so it'll be definitely worth your effort of just clicking that little red button. Go on, you know you want to do it. Go ahead and click it. Make sure you leave a like on the video if you haven't already. But for now, I'll see you in the next one, guys. See you later.